Hello and welcome to this week's Market Thinkers discussion. Along with Drew Meredith, my business partner, we have Andrew Canobi from Franklin Templeton. First Market Thinkers series. Why are we running this series? Essentially, it's about bringing thinkers of the industry to your doorstep or your lounge room or wherever your computer is. Essentially, a lot of clients see a line in their portfolio and it has a name, but it's not really connected to a person or a strategy. All they see is a unit price. So we're doing a series of these until the end of the year, and this one will be on bonds, and Andrew is our guest. A little bit about Wattle Partners for the people that don't know who we are. Drew and I run a business out of Melbourne called Wattle Partners. It has got origins back to 1973, where it was founded by one Austin Donnelly. Austin, we think, was the first fee-for-service independent firm, and we very much are still fee-for-service independent some nearly 50 years later. In this session, we have Andrew Canobi. He manages the Franklin Templeton Australia Absolute Return Bond Fund. It's a mouthful, Andrew. Typically, bonds considered a relatively boring part of portfolios, and something that we've found, Drew and I have found over the journey, that a lot of people do not understand completely. They think about bonds as just traditional term deposits, but there's a lot more to do with bonds, and today we're trying to demystify what bonds are and essentially how Andrew manages money. A little bit about this session and how it'll be run. Drew will first talk about the Franklin Templeton Absolute Return Bond Fund and why we included it as within our model and what elements we like and we think are appropriate to have an allocation in the model portfolio. We'll then go into 10 quick fire questions for Andrew to kind of understand the person and the product, and then we will start Q&A, which will go for about another 30 minutes. We'll actually talk about companies that Andrew holds bonds in. So why don't I pass over to Drew? Drew, how did we get to having Franklin Templeton's Absolute Return Bond Fund in our model portfolio?
Good question, Jamie. I think to answer that question, we kind of have to go back to the beginning, which is that bonds have been probably underinvested in most self-directed or Australian portfolios. Pension funds around the world have probably had something like 30 to 40% in bonds over the last few decades, but most individual investors would be lucky to have 5% at different times. To go back to the origins, they're pretty simple. They're loans to businesses. There's a big difference between bonds and equities, the difference being that interest payments for a bond are legislated and they have to be paid on a quarterly basis, whereas dividends, as we saw this year, are discretionary, and when times get tough, you don't pay dividends, you keep paying your interest instead, and they have to be repaid. There's three reasons that we've held bonds in the past, which I'm sure we'll go into more detail on, but that's to provide an income, so in the form of the coupon or the yield, to ensure we've got something to sell. So when equity markets tend to fall, is when bond markets perform well, giving you something to sell to if it's pay the bills rather than selling discounted equities. And part of that is also smoothing out equity market returns. But one of the big reasons we looked for and found Franklin was, as everyone's seen, interest rates around the world are basically zero now. I think just 10 years ago they were something like 6.5%. So you can't get much in the way of income from a bond anymore. And if the more articles you read, you can actually lose money from on bond investments if interest rates unexpectedly rise in the next 5 or 10 years. So there's only a few ways that you can protect from these risks, and there's very few strategies available in Australia that do it. Franklin is one, and in our view, they're the best. So that's why we picked Franklin, and in chat while we're speaking to Andrew today. So welcome, Andrew, and I think Jamie's going to go with those quick fire questions.
Thanks, Drew. Thanks, Jamie.
I think one of the points there, Drew, that you made was a lot of DIY and self-managed super fund investors aren't exposed to bonds. Now that's because traditional bonds have been in a minimum tranche of $500,000. Is that and essentially a wholesale product rather than a retail product? And a bit later we'll talk about the advent of those $500,000 bonds being kind of syndicated and available for smaller investors and the implications of that. But that's one of the reasons why you haven't seen a lot of bonds in self-managed super funds and DIY investors. So now, Andrew, we're going to ask you 10 quick-fire questions. We ask for short, sharp answers, but a lot of people do get tied up with their answers. So let's see how we go. This is a stock question. What's the best stock you have personally bought?
Well, trust me, you don't want stock tips from me. I was lucky enough to own Fortescue for a short period of time.
Yeah, great. Name one belonging from your youth you wish you still had. Did you buy anything early?
Yeah, I mean, it wasn't mine specifically, but I still wish we had my father's old caravan.
Yes, that's good. What's the personal investment decision you regret most?
Probably not buying Bitcoin at the start.
Yep. Pineapple on pizza?
Definitely.
You only can hold one stock. Let's say you're going to retire right today and you have to hold the stock for the whole of your retirement, or maybe more appropriate, one bond. So you're going to hold one bond for the next 20 years. What bond is it? All your money, every dollar
that's
you
harder
have.
than a stock, isn't it?
We know less about it, Drew, so you can probably tell us anything.
Yeah, I mean, that's a really tough one. One bond. I don't like portfolios that just have one position in them, so it's kind of hard. Stocks, I'd have to refer back to the question above. So
would that revert to the strength of the company if you had to pick one?
Well,
just
yeah.
say pass, Andrew. Pass.
They were supposed to be easy questions.
Okay, what's the best piece of business advice you've ever been given?
I think just focus on what you can do today and try not to worry too much about tomorrow.
Yeah, good one. Best investment for Armageddon: gold, crypto, cash, government bond, or maybe we'll add the Franklin Templeton absolute return fund in that.
Gold, whether it's Armageddon or not.
The best read you would recommend?
Yeah, I think the best business investment wisdom you can find is probably the book of Proverbs in the Old Testament.
Yeah, good one. Best region to invest in today: US, Asia, Europe, or Australia?
Asia.
And the one red flag that turns you off any investment?
Lack of financial transparency.
Okay, thanks, Andrew. Drew, do you want to continue the conversation?
Yeah, I think maybe just a quick introduction on your career, Andrew, and why you ended up as a bond investor rather than, I had on here, sexier equity markets. Maybe bonds are sexy, I'm not sure.
I really made the right call not becoming an equity investor. I don't think I would have been great at it. I started my career in banking and specifically worked in the corporate credit part of that business. My wife and I spent a fantastic 4 years in the UK, and that's where I became really interested in using my skills in the investment management side of the capital markets, and so that's where it went from.
Excellent. And I had another question: was what does a typical day of a bond manager look like? You know, we kind of see it as boring. You're not watching markets go up and down 3% like Donald Trump's doing at the moment.
It's really an interesting question. I mean, there aren't any typical days. I start reasonably early. I think in the current circumstances where we're doing a lot more working from home, there's a blurring between work and kind of leisure anyway. So, you know, I'm up, I'm thinking about events overnight, reading news. I read the papers widely. My team and I, we always have a catch up pretty early. And I actually like to write a physical to-do list, just to make sure that there's some things that I've got in my head that I make sure we get through. You know, there's a lot of administration in what we do, so it's not all kind of interesting and kind of exciting. There's just a lot of detail you need to attend to in terms of bank accounts and moving money around and so forth. And then there's always new deals coming to the bond market. So the bond market, a bit different to the equity market. There's always new transactions that are happening pretty much almost every day. So that takes up a lot of time as well.
So
excellent.
That's a good point. Versus the stock market, where most of our investors would know there's a really liquid, available market that anyone can access, that's priced daily, priced every second, really. Is that how the bond market works? If I was going to trade bonds directly, would I have a ComSec for bonds, or do you have a Reuters for bonds, or how does the bond market work versus, say, a share market that lots of our listeners are really familiar with?
So, I mean, the main difference, Jamie, is the bond market is what we call an over-the-counter market. So when investors such as ourselves are looking to buy or sell securities, we're not doing it through an exchange. We're basically interfacing literally with banks and broker dealers to sell or buy our securities from. And so there is a market. There are prices that you can view, but those prices are really only indicative because you actually need to negotiate directly with another counterparty to get something done.
Yeah, okay. So does that mean that there's more, you can execute more skill versus someone that has less knowledge? Is it the person with the most amount of knowledge, or the person with the biggest book gets the best deal in that market? Or how does that work?
It certainly means that particularly outside of government bonds, so in parts of the corporate bond market, you need to have a lot more focus on where is the liquidity, where are the buyers, where are the sellers, which banks actually have holdings of that bond, which banks are actually interested in buying it. And so there's a lot more art in terms of making sure we get the best prices for our clients than, I'm not going to downplay the art of transacting in the equity market, but to some degree it's a bit more simple in terms of you can see the exchange, you can see the buy and the sell.
Yep, got it.
I think a good place to start, I mean, the biggest differentiating point of your absolute return fund is the absolute return focus, which is mainly about duration. So if you could provide a bit of an intro on duration, why it matters and why your career is focused on this kind of shorter duration.
Yeah. So sure, Drew. I mean, when we talk about duration in bond investing, basically, as people, we think of duration as a measure of time, and that's true. Time comes into it, but basically what we're talking about is the sensitivity of the price of a bond to a change in the level of interest rates. So, for example, if a bond is priced at $100 and yields in the general market move up or down, then that will have an impact on the price of that bond, and the degree of that impact is what we call duration.
So essentially, a bond has a start date and an end date, doesn't it? So you would buy a 5-year bond or a 10-year bond or a 30-year bond. So there's time frame, and then the sensitivity of the pricing of the bond going up and down is what you call duration. So that's a kind of a measure of how long it's got to run and how sensitive to market movements it is.
Correct. Exactly, Jamie. And if we think about the last few years where, in general terms, government bonds have delivered very large returns, that's not been because they had high coupons or high yields. That's because the general level of interest rates has come down substantially, and they're generally quite long duration instruments. So the combination of being a long duration plus a big move lower in yields has meant the prices have risen.
Okay, great.
And the buyers and sellers are really about protecting from that risk too. That's why there's a lot of active management in the sector. Bonds are kind of thought of as being buy and hold by a lot of people, but they're active parts of major portfolios, and that's kind of the reason why they're buying and selling. You agree with that?
Absolutely.
So there's a relevant index in this, like a ASX 100 or 200 as well, isn't there? So what's the most common index that you would compare yourself to? Or if I was an index investor wanting to be really low cost and go and get an ETF off the ASX, what index would that be that you think is a good proxy of what bonds do?
Yeah, sure. I mean, so Jamie, the main index that people think about when they look at Australian bonds and think about what is the market doing is the Bloomberg Australian Composite Bond Index.
Okay.
And that's basically an index comprised of Commonwealth government, state government, and corporate bonds issued in Aussie dollars. So that's not the index we measure ourselves against, but that's the main index that the market is represented by.
So like the ASX 200, it's a combination of the biggest, the biggest bonds, or if you like, the most amount of debt out. And since bonds have a start date and an end date, is there an average duration of that index that,
Yeah.
duration being the right word, I think? Yep.
Correct. Absolutely. So, I mean, you're right. It's a market cap weighted index. So the biggest issuers comprise the biggest percentage of that index. And in this case, it's the Commonwealth Government. And after last night, we know that's unlikely to change.
Yep.
And the duration of that index, so the sensitivity of that index performance to a change in bond yields up or down is now about 6 years. So if you can compare that to, say, 10 years ago, it was about 3.5 years. It's not quite doubled, but certainly increased substantially.
Does that rule, if interest rates were to go up by 1%, the portfolio would be expected to fall by 6%?
Yeah, that's right. I mean, as a general rule of thumb, in terms of change in capital price, duration 6 years, interest rates rise by 100 basis points, 6 times 100, 600 basis points of capital loss.
Yeah.
Good one, Drew. I didn't know that.
And I thought another part to touch on would be probably a misunderstood term is credit spreads. And even credit spread duration. It's just another definition on a definition. And I think maybe relating that to your fund as well. So start with credit spreads, and I'll have a follow-up question.
So there's so many dimensions to bond investing. That's kind of what makes it interesting. So if we think about a bond that has a yield of, say, 2%, and the underlying government bond yield is 1%, and this particular instrument with the same maturity has a 2% yield, then it has a spread of 100 basis points over the government bond yield. For a corporate bond, we call that a credit spread. So the additional yield increment that you achieve by taking risk outside of the government sector.
Yep.
And so the credit duration is similar to interest rate duration. What happens if the spreads change, and how does that impact the price of that security?
Yeah, and how did maybe an example of what happened during March and April in terms of that credit spread? So what were they before, and what are they now on, say, I think if you got bank bonds in the portfolio, or?
Yeah. So investment grade, so the higher quality part of the corporate credit market, credit spreads going into the end of February, say, were quite narrow. They were below 100 basis points for an average maturity of 5 years. So not a lot of additional return. And then the COVID crisis, as it moved through in March and April, saw those spreads widen by more than 250 basis points to 350 basis points. So that had a substantial negative short-term capital impact on the price of those securities. And of course, a bit like equity markets, we saw a sharp sell-off, and now we've seen a sharp recovery as well.
And that was just people running for the door, people just selling to go back to cash.
Yeah, so it was definitely people running for the door. A lot of investors globally looking to raise liquidity into cash, and just a substantial amount of risk aversion on the part of large players in the market, particularly broker dealers.
Yep. I think.
So if we recap again, I want to get the basics right. So a bond is simply when an organisation, and that organisation can be government or semi-government or a company or even like us, wants to borrow money. So they would issue a bond, and typically that bond, let's say typically, I know there's lots of permutations here, but typically a bond would be, say, 5 years, and it would have a coupon attached to it. So I'd say, all right, I'm the organisation, let's say I'm the Victorian State Government, I need $100 billion. I'm going to issue these bonds. Let's say I just need $100. I'm going to issue these bonds for 10 years. I'll give you money back in 10 years, and I'll pay you a 5% coupon quarterly for that full 10 years. Now that stays the same. The interest rate stays the same for the full period. So when we talk about credit spreads or yields changing, or Drew's got another term here, running yields, the only thing that potentially can change in that 10-year semi-government bond that's got a set coupon, is the price.
Yep.
Is that right? Yep.
Correct.
So we're talking about price movements when we talk about changes in bond valuations.
Correct. That's exactly right. So, I mean, just like an equity, bonds have prices. And so depending on what, beauty is in the eye of the beholder. So, once you own a security, other participants in the market may decide actually it's more valuable or less valuable than the price you paid for it.
Yep. And then time is ticking, because closer you get to that 10 years, the closer you'll get the $100 face value back.
That's right. And in some ways, equities are different, but there are equities that are bond-like as well. And someone once said to me that an equity is basically a perpetual variable coupon, deeply subordinated bond. So in other words, it has a very long time horizon or duration, but a variable coupon because we don't know what the dividend is. And therefore the price is a function of whether people think, it's undervalued or overvalued at a particular point in time based on those factors. So
I'm just going to make that point again, that when the company enters and has a bond on issue and you own that bond, they're contractually obligated to pay the interest every quarter. It's not like the board could meet and decide, hey, we're not going to pay our interest this quarter, because that'll be a default. They'll go into receivership, where when that board meets and they're paying a dividend, and maybe like a bank, they've paid a dividend for the last 25 years, if they're having trouble with their capital management, they can always suspend a dividend. They can't suspend a bond payment. So what that means is, from an investor, we have a little bit of certainty. First, we have a certainty that it will mature at some point. That might be 5 years, 2 years, 10 years. And we're certain that the company must pay our payments every quarter or every 6 months, else they're going to go into receivership. So just wanted to make that point, and maybe I've overemphasized it.
I think that's a really excellent point, and we've seen a number of high-profile examples this year where, as a bond investor, you've done really well, but the equity investor in the same company, it's been a tough year. I mean, we've seen high-profile companies, some of the banks, Sydney Airport, the real estate groups, have to dramatically curtail their distributions of their dividends. They've raised equity. They've made decisions that have not necessarily helped their stock performance, but from the position of someone who's a lender to the company, it's been a great position to be in. And as you say, Jamie, in that regard, being a bond investor is actually quite a simple enterprise, as long as you make sure you've got the right exposures in your portfolio.
Another fund manager pointed this out to me the other day, and it's really obvious, but it never ticked with me, that if you've got bonds on a company that's listed on a public exchange, they can always raise capital. Now that capital it's very unusual for an ASX, any stock market company to go bankrupt, because their ability to raise capital is there. It might be at deep discounts, right? It might be a 50, 70, 90% discount, but as the bondholder, you don't really care, because essentially all you're worried about is the bond, which has got starting value and end value and a coupon, and you're just worried about the solvency of the business. So if they're going to raise money at a 90% discount and you're a coupon holder, all the better. It's which is another reason why having looking at if the company's listed or not listed, and their access to recalibrate their balance sheet must be something that you consider. Do you, Andrew?
Absolutely. Yeah, absolutely. So, I mean, we've had interesting examples this year in, for example, the real estate sector. So you look at a company like Vicinity Centres, which has done exactly what you said, raised equity because they're a public company, taken some very, strong decisions to protect their business, build a large amount of cash on their balance sheet in order to help them navigate a period where, the retail environment's obviously been weaker. And as a bond investor, it's been like all the Christmases have come at once, because actually the underlying credit profile, or the probability of getting your coupon and principal back in a timely manner from that business hasn't changed at all. In fact, it's probably strengthened because of those decisions.
I think one of the big reasons we sought out your your strategy, the absolute return strategy, was the very different position we find ourselves in today compared to, say, 2010. We were kind of quickly discussing this beforehand. You're pretty opinionate. You've got some strong opinions on the outlook from your fixed income desk updates that come out. Can you give us a bit of a comparison to, say, 10 years ago and today? So government settings, what the ballooning or the growing debt means for bond returns, and what risks you see?
If you go back to the middle of 2010 and you think about the start of the last decade, and this is where bonds are very different to equities, because the nature of the asset class. So if you look at the Australian 10-year government bond yield 10 years ago, for example, its yield to maturity was around 5.6%. It had a duration, which we talked about earlier, about 3.5. So the index itself had a duration of 3.5 years, that is, and a yield to maturity of 5.6%. And then we had a 10-year period, the last decade, where bonds had some good years, they had some bad years as prices moved around, but on average, the annual per annum return for that index was 5.3%. So the return was kind of approximate to the starting yield, but obviously we had ups and downs on the way. Now today, the yield on that same index is about 0.75%, so not even 1/5 of what it was. And that duration or interest rate sensitivity is 6 years, so it's nearly twice. So the one thing I can say with absolute confidence is if we're having this discussion in 2030, we will not be enjoying the same returns from that index that we have in the last 10 years. The only way we will is if you can persuade me that yields, not just interest rates, but yields on bonds are going to go to negative 4% or lower. And
is that possible?
I don't think any of us are sitting here saying anything's impossible in this kind of crazy world we're living in. But aside from that statement, I would say it's so unlikely and improbable as to be, almost excluded. So in other words, we are not going to have anywhere near those returns from just simply putting your money into an index and forgetting about it. That opportunity is now gone, and that's why it is different to the equity market, where there are still genuine growth opportunities to make money for your capital.
And what are you doing what's the absolute return strategy doing to not lose money and to actually make money? If so, you're kind of taking the view that interest rates have to be higher in the next 10 years, or maybe the same, but at least they can't be lower, basically.
Yeah, so I mean, this is where it gets really interesting, because we're starting off with very little yield on the table. So optically, you look at the asset class and go, oh my goodness, how am I going to make money? But what we do is we start off with, we don't start with that index, we start with cash or a neutral position. And then we actually look for opportunities where we see genuine scope to add value from a change in price or from an earnings stream of a bond. And we look for an outcome from that position over a short, medium time horizon potentially. And when we get that outcome, we move on to something else. And so we are not so much of a buy and hold and kind of just let it work itself out investor. We're quite active. And the good news is, even in this environment where yields are low, where credit spreads have moved around, there are always good opportunities to identify within that framework market securities and opportunities that actually are compelling, even in that environment.
Yeah, I think maybe there's a question around duration. So the strategy can be negative duration.
Yeah.
Can you explain what that means? And obviously, if you're long duration and interest rates go up, that's bad. If you're short duration and interest rates go up, that's good. How do you do it? And
excellent question. So I mean, so we start off with cash or a neutral stance. We don't have any duration in the portfolio, and to us, duration, in other words, do we want to actively expose our clients to the sensitivity of the bond market to interest rates? Well, that's a function of our investment process telling us that particular outlook is positive, and yes, we want to have some duration in the portfolio, Or it could be our investment process saying, actually, no, we think bond yields are going to move higher. We want to be negative duration. We not only want to protect our investors against yields rising, we actually want to make money from it. Now, we haven't seen that in the last few years. We've generally seen bond yields kind of doing this, but given where we are today and the circumstances that are being deployed by governments to battle, the recessions we're in, we think the next few years we are more likely to start to see some of those trends emerge. So we've got that flexibility to do that. And people often say to us, what's your duration in your portfolio? And we say, well, it depends. Right here and now, I can give you a figure, but that was probably different from a week ago, and it will probably be different from a month ago. So our duration changes a lot because we're always looking to adjust our exposure depending on what the market opportunity is and looking for a particular outcome over a time frame.
Your fund is called the Australian Absolute Return Bond Fund. So it only buys Australian companies' debt, is that right? Or does what is your realm? Does it own government, semi-government, and corporates listed and unlisted, all Australian, or do you hold other? Is that right? Sorry.
All of the above. So let me explain. I mean, the term Australian is really our way of saying we've designed this for Australian investors. Okay. And it does have a focus on Australia. So we start with the Australian universe, absolutely. That universe, again, unlike the equity market, is very diversified and global. So yes, we've got the Commonwealth government. Yes, we've got state governments issuing in Australian dollars. But then if you kind of look at the rest, you've got this very, very large, diverse array of companies and governments who come to Australia, who come to our capital markets and raise money because we have a lot of money. We have a lot of money in our super system. We have a very large financial market structure. So outside of our governments, state and federal, and you look at the rest, banks and corporates, more bonds exist in Aussie dollars that are from global issuers than local issuers.
Can you give us some examples of global issuers of Australian bonds?
So, for example, we own some bonds issued in Aussie dollars by Verizon, which is one of the United States' largest integrated telecom providers, kind of like a Telstra of the US, but much bigger. We have exposure to some very high quality financial institutions like DBS, which is one of the largest Singaporean banks, BNP Paribas, one of the largest European banks, for example. These are all very active issuers in the Aussie dollar bond market.
Great. And go, Drew.
No, that's all right. You're fine.
We haven't talked about credit ratings yet. I'd like to talk about credit ratings, but does your fund does it have a combination of government or semi-government or corporate? Does it have the ability to go across all? Is there a line in the sand where you want to be?
Yeah, so we have the flexibility to invest in both government and corporate securities, as well as mortgage-backed securities. We don't have much in that space, it's fair to say. But in terms of government versus corporate, at the moment, we're about a third in government or government-style bonds.
Yep.
We're about 60% in corporate bonds. But within that corporate exposure, we're pretty defensive in our kind of stance at this stage. So corporates being, regulated utilities, for example, infrastructure borrowers like, APT pipelines. So businesses that are still willing to pay you a higher return because they are a corporate, but the nature of their business is very, very strong, very almost monopolistic in style, for example.
Non-cyclical.
Yeah.
And let's just talk about
investment grade.
Credit ratings for a minute, yeah. So what a lot of our listeners wouldn't understand credit ratings, and through the GFC, they probably didn't really want to know about credit ratings. So credit rating is essentially a way to differentiate something that is 100% sure that they're going to pay back your money, like a government, like an Australian government, and then it goes down from there. So the most secure, I think I'm answering your question, Andrew, the most secure being AAA, and then AA and A, and then it goes BBB, And all those 4 categories you call investment grade, don't you? Investment grade meaning that there's a fair chance you'll get your money back. And then there's a sub-investment grade that goes double BB and then out the back to junk. So do you use credit ratings as a source to make decisions? And, where's your fund kind of position within those categories?
No,
and correct where I'm wrong with that. Cause,
no, you're spot on. I mean, all those comments are entirely on the mark. So, in other words, the major credit rating agencies, Standard & Poor's, Moody's, and Fitch as well, basically assign a rating to both issuers. So, in other words, they'll assign a credit rating to Telstra or the Australian Commonwealth Government, and then they'll separately assign a rating to the individual securities that they issue. And the reason they do that is twofold. So, for example, if Australia has a AAA rating, it's basically the rating agency saying they have the highest probability in the world of paying back their investors' coupon and principal. And if a government issues in its own currency, then really it can't default because it technically can always print the currency to repay its investors. A corporate can't do that. It has to actually earn money to repay its investors. So corporates can be AAA, but they typically start to move into AA, single A, and triple B in the investment grade space. And as you get lower, AA, single A, triple B, basically it's the agency's assessment on a number of dimensions that the risks of investing in that are slightly higher. And so, as you mentioned, as you go below triple B into double B, B and triple C and beyond, that's what we call high yield. That's what we call the below investment grade market. And that's where you really start to get genuine default risk coming into the picture, where it's high yield, as the name suggests, but it's high yield for a reason, because you need to really assess very carefully the ability of that issuer to pay you back. So we use ratings. They're quite important. We always make our own independent judgment of an issuer in terms of how we feel about their credit position, rather than just relying on the rating agencies. But we certainly do read their research and use them.
Is that a source of return as well, where you can see a company being upgraded quicker than the rating agency can?
It is. So it's a good question, Drew, because the bond market does have a bit of a bifurcation between this investment grade and below investment grade category. So a lot of institutional investors globally, because of their particular investment restrictions, can't buy bonds that are below investment grade. And a lot of specifically focused high yield or below investment grade investors don't want to buy above high yield as well. So you have this cutoff. And so what happens is sometimes a company will be triple B and it might move below investment grade. So Ford Motor Company, that happened to them this year. And so all of a sudden, a lot of investment grade investors had to sell their bonds, and a lot of high yield investors, became more interested, and vice versa. So sometimes there are interesting investment opportunities in that grey area. So you often find there are good companies that are rated in the high double B area that are in many respects investment grade in their financial strength, their balance sheet strength, but haven't quite managed to get the rating agencies over the line. Fortescue Minerals, I think, is a great example. So it's obviously one of Australia's largest mining companies. Iron ore is their focus. They have some risks if you consider that they're basically producing one commodity and they don't have a diverse client base, but it's a very, very strong company, very, very conservative balance sheet at this stage. And their securities are actually rated in that high double B space. So, from time to time, we have owned selectively positions in that company where you're being paid very, very substantial returns to own a company that kind of looks investment grade, but isn't quite there.
And what's your allocation or limits around below investment grade? So that's triple B minus and lower?
Yeah, so in below investment grade at this stage, we don't own anything. And that's just a reflection that we're more cautious now on credit generally. We didn't buy anything through that March, April sell-off because we just felt that again, the opportunities weren't as compelling as in investment grade. We could potentially have up to 20% exposure in names in that sort of double B category. Generally, over time, we wouldn't have had more than 5 or 6%. So we've always got a little bit more bandwidth that we typically have worked with.
I wasn't sure if we touched on floating and fixed rate bonds earlier as well.
Yeah.
Is there a market for both in Australia? Are you using both?
There is, and we are. So it's another dimension to bonds. I mean, there's always so many things going on in bonds. There's fixed rate bonds, floating rate bonds, subordinated, senior. Floating rate bonds don't have the same interest rate duration as a fixed rate bond. So if you buy a 5-year security that's got a fixed coupon, then it will fluctuate in price much more because of the sensitivity of the bond to a change in bond yields. If it's the same issuer 5 years, but it's got a floating rate coupon, then basically its coupon resets every quarter according to the short-term interest rates that are prevailing at that time. So it doesn't have the same sensitivity to long-term interest rates, but what it still has is the same 5-year sensitivity to a change in credit spreads, for example. And so whilst it can appear to be a more stable security, when you have a period like we experienced in March and April, you can still see prices fluctuate quite wildly through that period.
I had a follow-up, maybe it's back to what Jamie alluded to in the beginning, which was groups like FIG and Mint that are doing the, syndicating the big tranches of loans. Your portfolio holds something like 170 individual bonds in it. On the first, you can see the difference. What's the benefit of investing in a more diversified fund compared to picking the deals that are they feel like IPOs almost, where we see some of them that come out?
I mean, most of the positions we own, you can't buy as a retail investor. So I think that's another difference to bond investing and equity investing. You could build an equity portfolio directly, I guess. But in all honesty, if I showed you the list of securities we own in the fund, and then you took that to a counterparty, they wouldn't be able to buy them for you because the market just doesn't deliver these securities to retail investors. They obviously have minimum size restrictions as well. We own bonds in Aussie dollars. We own some bonds in US dollars where we've hedged the currency. There's a lot of work that the bond market is just quite challenging actually to build portfolios.
Maybe that's a good point to talk about. You seem to be a boutique kind of manager, but within the structure of Franklin Templeton. And what does that do? We've dealt with you a number of times. You're very open. You talk about your fund, but then there's this big strength of Franklin Templeton. Anyone that doesn't know Franklin Templeton recently bought Legg Mason, one of the top 10 firms on assets under management in the world, originated out of the US. But your team seems to be very much like Drew and I in a way. You're running your own shop. You're investing your own money. Can you talk about operating a business within more or less a big business?
Yeah, no, thanks, Jamie. I mean, that's exactly how we think of ourselves, and Franklin now would openly describe itself as kind of almost a holding company that owns a number of specialized investment groups that it charges with the task of basically building and running the solutions that the investment groups think are right for their clients. And what Franklin does is it brings the strengths of a large company in terms of allowing us and therefore our clients to access a very large array of opportunities. So we can connect with our colleagues overseas in terms of sharing research, etc. For example, being a manager that now has, I think it's $1.4 trillion of assets totally, gives us a lot more negotiating power when we're trying to drive down costs that you need to do to run a funds business. So legal, compliance, operational costs, all these things, we want to drive those down as hard as we can, so we can bring our capabilities to our clients and do it at a cost-effective level. So that's a really important point. But we have a lot of autonomy within what we do. So we're part of the big firm. Every decision we make within our our team based in Australia is our decision. We don't have anyone in California or London saying, here's our investment view. You must put that in your portfolio. Our investment view is basically ours, but we're connected with our colleagues with whom we can share ideas and research.
And for the listeners, it's a big trend that Drew and I have been talking about and writing an article on. Is 20 years ago, there was a number of fund manager groups that started and are incredibly successful, come to mind Platinum and Magellan. And when they first started, they were basically one-man shops or two-man shops. And, if they needed to get through an investment committee like ours and the due diligence that we put through, they'll never have been, they'll never get through, essentially. So you've seen a lot of professionalism within financial planning, a lot of investment committees, a lot of due diligence, a lot of third parties. So, we favour groups that kind of are nimble enough to manage their own money and have autonomy, but then also have got the governance and compliance and research of a very large group sitting behind them. So,
no, thank you.
Drew,
I had one I think worth discussing was what happened in March. When I was watching it, the volatility in bond markets were close to equity markets at different times. At least, the 10-year spread on government debt. So how did the fund perform during March? Were there any changes that need to be made, and what did the benchmark do as well?
Yeah. No, it was a really incredible month, wasn't it? It seems so long ago now.
Did you sleep as well?
No, not at all. Oh, look, I mean, nothing makes me happier or sadder, I won't say in life, but almost, than how we're performing. I mean, it really is one of the great joys of being in this part of the business. When things are going well, it just is wonderful to sort of feel like, we're doing what we want to do. We're helping our clients. It's a great feeling. And when things are tough, I would say personally, that's when you learn the best lessons, perhaps not only in investing, but in life, when things are really, really difficult. And every 4 or 5 years, I would say since the GFC, we've had challenging market conditions. This has been the biggest one. If you think about that, between that second and third week of March, which is when COVID-19 went from, gosh, this is a problem, to, oh my goodness, this is a real problem. We're going to need to sort of curtail economic activity. Government started to shut things down and markets really fell apart. What happened was, in the US, investor concern became so elevated that there was a wholesale withdrawal of money from the financial markets. So Treasury or government bond mutual funds in the US lost several $100 billion in 1 week. The cash management fund industry in the US, which is very, very substantial, it's a very, very big provider of liquidity to companies and banks, lost about 10% of its assets in 1 week. So you saw money kind of literally, or metaphorically, going under the mattress, and that kind of was what really set off the wild gyrations that you mentioned, Drew. So we had gone into that month with a few things in our mind. Number one, we still were slightly long duration. We still thought interest rates were falling, but we kind of started to take that position out as the month progressed, and we were probably a bit early, but nonetheless it was still working for us. And so as government bond yields had navigated a lower path, we generally had moved higher in quality, but still stayed invested in some investment grade credit. So still the same sort of sectors I mentioned, very defensive. But even those defensive sectors got absolutely hammered. So the fund in March itself did have a negative return, which was disappointing, but not surprising given the quantum of moves that we had. But it was pretty manageable, and more importantly, we had such a defensive stance. We had a lot of liquidity. We had some cash. We had government bonds. And so as we moved through that period of March into April, and we could see the steps that central banks were taking to ensure that liquidity to the system was provided and things could be navigated, we started to buy some of these bonds that had been beaten up really badly, but had great business models. So I mentioned, names like Vicinity Centres, Coles Supermarkets Group, companies that were almost, I would say, COVID-proof, but where the returns that you were getting paid to take bond risk were incredibly generous. And so we shifted a lot of capital into that opportunity. And then, of course, the last few months, we've seen that work really well.
And how many negative monthly returns have you had in your history?
Yeah, so look, it's not a big number. I'm going to kind of say 95% of monthly returns have been positive.
Yep.
At least, but yeah, don't quote me on that.
So it's
but
very rare.
It's not a big number.
And did you get many redemptions in March? I think there's always this misunderstanding of managed funds being illiquid and bonds are traded over the counter. So,
Yeah,
did you get many redemptions? Were they all met
we actually
quickly?
had some reasonable redemptions, mainly because we had some clients who wanted to use that opportunity to buy equities and put some money into other parts of the market, and so and that was fine. I mean, we never had any issues in terms of what we were able to deliver. When you're running an open-ended unit trust with daily applications and redemptions, you have to be able to deliver on that, I think. And so that was a good test for us to be able to do that.
So even when markets were volatile, you could still call and sell your Aussie government bonds. Plus, you had some cash available to pay that as well.
Yep.
Back to that point about March, Andrew, and we saw this in the last quarter of 2018, markets seem to react when they react at the moment. And it's probably different than your career over your career, but at the moment it seems to be deeper cuts. Well, I say deeper cuts and heal quicker. So it seems to be markets fall off very, very quickly. I think March was one of the quickest fall-offs we had. The last quarter of 2018 would be one of the quickest as well. But the recovery was even quicker. And you go from a portfolio manager's perspective, that must be incredibly hard. It must put a lot more pressure on you. It puts a lot more pressure on us because the decisions can't be deferred. We couldn't, and we did some good changes in our portfolios for our clients, but you couldn't defer it. Like you can't say, hey, I'll defer it to the next investment committee, because by the time you defer it to the next investment committee, the whole, effectively the cut is healed up and that opportunity is gone.
Yeah.
So do you guys, is that just us feeling like that, or is that how you guys feel too, that that markets do have the propensity to fall off quickly and recover quickly?
No, I think that's exactly right, Jamie, and that's why certainly the way we manage money, and I would argue it's an important attribute to have in your broader portfolio, is at least have managers who can react really quickly, people acting on your behalf, because you don't get the luxury of waiting for the next investment committee cycle or whatever it is. I am surprised. We were surprised how quickly markets bought the recovery before the recovery was kind of, such as it is, realized. But I think that speaks to just the fact that markets are very forward-looking. They're always thinking, well, not what is the circumstance today, but where are we going to be in 12, 18 months' time?
So that's a good point. Have markets priced in a cure for Corona?
The budget has.
I think
the budget's repairing the damage before it's even over.
You would have to say that the markets are at least 80% now assuming we have some sort of vaccine breakthrough as we move into 2021. And look, in terms of our research and our internal discussions, that's probably not unreasonable. So yeah, it then becomes a question of, well, what does well in this kind of recovery phase that hasn't quite performed, and what are the opportunities even allowing for the fact we've had a big move generally up.
We just had another question about Franklin Templeton, and in our core portfolio we actually have two investments that are Franklin Templeton. So we have your fund, which sits in the fixed income or the alternative defensive alternative portion, so the defensive portion of clients' portfolio. And then we have in the growth allocation, which covers Australian stocks, international stocks, and some liquids called growth alternatives. We have the Global Growth Fund run by Don Huber and Francine out of Sydney. Excellent fund. It basically invests into shares in the mid-cap market, very similar to what you're doing here. He's running a group out of New York, obviously one person in Sydney, that is essentially managing money within the big structure of Franklin Templeton, but it's his team that is managing money. So we've just had a question about, are they, how do the two groups work together? Obviously one more or less parent, Franklin Templeton, and all the resources like research and governance and marketing, and then you've got your own group that operates within that, and similar to he operates within that. Do you have any contact? I mean, I assume the portfolio has no overlap at all between the two, and do you have any contact with Donald, or he's another portfolio manager sitting under the banner of Franklin Templeton in New York?
Yeah, we don't have any formal contact in terms of a regular meeting where we share ideas or anything like that. We're operating quite independently. I'm actually very good friends with Francine, who's based in Sydney. So we talk about everything from politics to markets, just ad hoc. So we have contact as we do with other investment teams, but we are quite distinct in terms of our process and approach and holdings, etc.
They're a phenomenal team. They've done so well over a period of time where if you weren't exposed to a handful of stocks, you had no performance at all. And they weren't exposed, but their performance is exceptional. So.
Yeah,
no, they've done really well.
Okay, maybe a quick finish on what you're looking forward to or worried about for 2021.
Well, let me tell you.
Not 2020, we're almost finished.
Let me start with what I'm looking forward to, which is basically getting out of my home and getting out of this 5K radius that they've got us stuck in and seeing my kids back to school. I think so many things that we take for granted just in terms of normal life. All of a sudden you don't have those things and you go, oh my goodness, I just want to go for a drive to the country or whatever it is. So that's
it's so true. My dog just ran into the room with my daughter's favorite toy, ripped to shreds, and then the daughter ran in with tears. So we all need to get out. There's not many teddies left.
So I think that's the easy one. And I think look, in terms of the outlook from here, barring a big setback in terms of the medical progress that's being made on COVID, I think 2021, we've got more cause for optimism in terms of the economic recovery in Australia and globally, which is great. I think the US election is going to be far more uncertain and volatile than what people might think. So I know markets are starting to think more conclusively about a Joe Biden victory. I wouldn't be so sure necessarily, but there's a long time to go. So I think 2021 is going to be interesting, hopefully less eventful than 2020. But there's cause for optimism, I think, on a number of fronts.
Excellent.
Yeah, we might leave it there. Thanks, Andrew, for your time this morning. Really appreciate the candid answers and helping us explain bonds a little bit more to our clients. If anyone has any questions further to what they've asked, are you happy to answer them if we send them over to you?
Absolutely. I'm more than happy to answer any questions people have. So it's been a real pleasure, and I really enjoyed the conversation. And thank you, Drew and Jamie, for having me on.
Yeah, no problem at all. All right, so that concludes another Market Thinkers interview. Join us next week, same time. Thanks, Drew. Thanks, Andrew.
Thanks, everyone. Have a great day. Thank you.